Thank you for joining me here today. I'm Ashley Murphy, a certified financial planner, global financial planner, founder and principal of Arete Wealth Strategists. Thank you for joining me here for today's presentation, Strategic Exits for High Growth Businesses, Navigating US and Australian Cross-Border Tax and Estate Planning. This is a very dense presentation, and we're going to use next month's presentation to go into greater detail on a couple of these items, more information to come on that. I did want to make you aware that this information here does not constitute personal financial tax or investment advice, should not be relied upon as such. All material here has been sourced from what we believe are reliable sources, and just note the style note that we have there. Remember, we have a YouTube channel. If you register for a webinar, then you will be notified once that webinar is posted on YouTube. Last month's webinar, probably our most popular ever, with about 240 registrants for that webinar. Social Security Changes in 2025 is up, so you can find it there. And feel free to subscribe if this is content that you feel is relevant to you and your situation. A little bit about me. So as I say every month with every presentation, this was really a field I was born into as a tri-citizen, raised in Australia, born in the UK to an American mother. I spent 20 years living in the US and traveled back quite frequently, as frequently as 3 times a year, including on Saturday this week, headed to San Francisco and to Austin, Texas, for a conference that we're hosting with the Global Financial Planning Institute. So let me see what to mention here. It really was around 2010 that I was actively working in the field, and I was beginning to network and trying to understand who was it out there that was focusing on these cross-border issues. And what I discovered was that there really was no one. There was no organization. There was practically nothing out there. There was a little chapter within the Financial Planning Association that dealt with cross-border issues, but they provided no education, no way to get started with this, other than to simply learn it yourself from the ground up. So that's what I did. I did a graduate diploma in financial planning in Australia, and of course was an instructor at UC Berkeley Extension and Golden Gate, teaching financial advisors as they came through as well. Here are 3 examples of client situations: a business owner, a high net worth family, and an Australian executive and family having permanently relocated to the US. They've approached us with various goals and things that they would like to accomplish, and there are the results listed there on the side. So we've been able to add value far in excess of our fees, and really priceless peace of mind for them, knowing that they have avoided costly missteps and taken advantage of the opportunities available to them. So today's presentation, here's what we have. QSBS, we'll take a quick look at what qualified small business stock is about. We'll look at the qualified business income deductions and pass-through entity optimization, estate tax mitigation strategies, exit tax and expatriation planning, and last is post-exit wealth preservation. So next month's webinar will actually be going into greater detail on some of the techniques mentioned here with estate tax mitigation and post-exit wealth preservation. Many of you who may have attended previous webinars will know that I've done a number of webinars talking about the exit tax, which is always a very popular topic. So let's get into it. QSBS. Not a lot of folks who aren't business owners have heard of this, and really, why would you have if you're not a business owner? It qualified small business stock coming under Internal Revenue Code Section 1202 applies to stock issued by eligible domestic C corporations. Note C. C means if it's not a C, doesn't apply. There's very strict requirements for you to have QSBS eligible stock. And in fact, an interesting story, a relatively new client of mine, a client we've been working together with for about 4 months now, is just having an exit from a QSBS eligible investment that he's got netting about $16 million tax-free. And we'll get to that. It's designed to incentivize investment in particular small growing businesses, not all, as we'll see in just a moment. it offers an exclusion of up to 100% of capital gains on QSBS sales held for at least 5 years. So here, let's just begin racking up what are the requirements. C Corp must be held for 5 years, cannot exceed 50 million in basis originally. We'll get to that on the next slide. Potential exemption from AMT. Okay, so C Corp, as I mentioned, aggregate gross assets must not exceed 50 million at issuance and immediately thereafter, because it's qualified small business, emphasis there on small. Any stock issued after reaching the threshold will not qualify. So there actually is a very specialized field of accounting, and that's what I helped that business owner client with, was trying to locate an accounting firm that really understood QSBS, because the bigger your wealth, the greater that bullseye is that appears on your backside from the IRS. And so we want to be sure that this is done correctly. At least 80% of the assets must be actively used in a qualified trade or business, meaning it cannot be an investment firm. You cannot sit with 20% of your holdings in treasury bills earning 4.5%. Shareholder requirements. Stocks must be acquired directly from the corporation at original issuance, cannot be via a secondary market. Minimum holding period 5 years, as I mentioned. There are some exceptions for what may be deemed original issuance, i.e. through options, warrants, convertible debt, etc. What is excluded? This is a real bummer for me, professional services and financial services, as well as hospitality. Now, restaurants I get, but it actually includes hotels also, and natural resource extraction. That maybe there's enough tax breaks going to natural resource extraction already, and they didn't need to see the need to incentivize that further. This is actually law that's been on the books for many years. This looks like some sort of Trump era, reshoring of domestic manufacturing, but it's not. It's been around in its current form, I believe, since 2012, with the 100% exemption on QSBS eligible stock. So here's some examples to help solidify our understanding of it. So a sale with a gain of less than $10 million, acquisition date of 2015. So they've held it for 5 years. We know that much. Original basis, that means investment was made and assets, net tangible assets of the firm were $3 million at issuance. Sale price is 25 million. There was a gain of 22 million. Remember, it's the greater of 10 times or $10 million. So in this case, 10 times the basis of 3 million leads to a 30 million exclusion. They didn't have 30 million of gain. They only had 22. So exclude a gain of 22 million. Very nice. Thank you very much. Sale with a gain of greater than 10 million, but low basis. They're going to be subject to the $10 million limit. So there's no basis when the firm started. So therefore, 10 times nothing is still nothing. So we're subject to the $10 million limit. There's 8 million of taxable gain. No one will be bringing out their violins and crying too much in that circumstance. Sale with a gain of greater than 10 million with a higher basis. So 1.5 million in basis, sells for 16.5, taxable gain of 15 million. Again, they're at the max right there. 1.5 times 10 is 15. They had 15, so the whole thing was excluded, nothing taxable. An investor with $10 million with a $100 million gain. This is really, really rich, this one. So we're starting with a much higher basis, a $10 million basis. Remember, 10 times 10 is 100. Selling price, 110 million. There's 100 of gain. So that's entirely excluded. And then lastly is the most complicated example, the installment sale with $15 million of gain, zero basis in the investment. Therefore, there's going to be 10 million of gain that will be excluded. But because it's an installment sale, that means they're getting paid certain amounts in certain years. So in the first year, the excludable gain is $9 million. And then the taxable gain will be $6 million in year 2. So you would be the accountant in that situation would do well to advise the client to hold on to probably $2 million to meet that tax bill on the 6 million that's coming due in the second year. However, there are other possibilities, and we'll talk about that, such as a Section 1045 swap to defer taxation. So here's a handy dandy chart that I found from Stripe, the payment processor, that walks us through whether you have QSBS eligible stock. And so, as I said at the outset, there's very specific requirements. Do you have a C Corp by from a non-corporate taxpayer? And is it a qualifying business, meaning not financial services, professional services, hospitality, or natural resource extraction? Yes, great. 50 million aggregate gross asset test, meaning less than that. Yes, you're in good stead. 80% of assets used in operating the business, meaning the other more than 20% cannot be sitting in some sort of investment account. If that's true, yes. I didn't know about this one. This is a little more technical. This is where the accountants get involved. Did the company redeem shares from a stockholder 2 years before or after the shares were issued? Or did the company buy back more than 5% of aggregate shares 1 year before or after the shares were issued? Well, if they did do that, bad news, you don't qualify. If they didn't, shares holding, you've got to hold it for 5 years. Yes, you may be eligible. And if it's less than that, you can consider a 1045 exchange into some other qualified business equipment. Okay, special considerations for Australian business owners would be the Delaware flip structures. So this is where you take your Australian business and you just flip it into a Delaware business, thinking you're too cool for school or too clever by half. Well, you would be too clever by half by doing that, given that that would make it ineligible. It's not considered original issue. So bad news there. Establishing a US subsidiary directly for issuing shares can preserve that QSBS and may trigger immediate tax implications if shares have significant initial value. And that share implication, sorry, the tax implication may be on the Australian side if you're having some sort of liquidity event in order to take advantage of QSBS if your business is going to be staying and growing in the US for the foreseeable future, hopefully the next 5 years minimum. QSBS benefits apply at the federal level. Remember, so state level conformity to QSBS varies. Again, talk to your qualified tax counsel on this. Australian owners must carefully manage their residency, their tax residency, to optimize cross-border tax outcomes in QSBS. I did not say domicile there because domicile is a tax concept that has more of an impact on estate tax, as we're about to see. Documentation and compliance, always want to make sure you've got very detailed records to justify the claim that you're making, and obtain an annual QSBS attestation letter from issuing corporations as documentation for IRS compliance. QSBS, so wonderful opportunity for folks that meet those particular conditions. Next, QBI deductions, qualified business income deductions, and pass-through entity optimization. So this is something that came into effect with the Tax Cuts and Jobs Act of 2017, Section 199A, and it allows a 20% deduction for qualified business income from pass-through entities. And the deduction is taken at the individual taxpayer level, not at the entity level. Well, they're pass-throughs by definition, so that would imply that. And it applies, this is a really cool thing, if you're eligible for this, it applies whether the taxpayer itemizes or takes the standard deduction. So again, specified service trades or businesses, the same list actually that we just saw. So the professional financial services, hospitalities, and I don't know about natural resource extraction on this one. It did not specify that, but those are firms or types of firms that are subject to a phase out. They're not excluded entirely, subject to a phase out. The 2024 phase outs are on the next page. Wage and qualified property limitations may apply, restricting deductions based on W-2 wages paid and unadjusted basis of qualified property owned. Okay, so actually I'll come back to that. Here's what I was mentioning a moment ago. The 2024 limits, the reason I'm not saying 2025 limits is because there aren't, as of today, published 2025 limits. And the reason for that is because, as I mentioned, the TCJA sunsets at the end of this year. Very likely that the Trump administration will extend it, given that this was their first major legislation passed back in 2017. So It is theirs. It will, however, have significant impacts on expanding the otherwise growing, federal deficit. But nevertheless, for a married filing joint shareholder, that's what you're looking at, is being completely excluded from this deduction with income above 483. Just bring it back here to structuring considerations for Australian owners. You've got your pass-through entities eligible for QBI deductions, obviously very straightforward. When you own a business through an Australian family trust and you're located in the US, it can be a disaster. I've seen this firsthand. Many of you long-time listeners will recall an example of a Silicon Valley, very successful Silicon Valley company that originally owned their shares through an Australian family trust, came to the US, had a liquidity event. We're looking forward to the lower US capital gains brackets that would apply, but no, because those shares were originally held through an Australian family trust, the source of the gain goes back to Australia, and to add insult to injury, you're looking at non-resident rates. So that would have been as high as 45% plus 2% for the Medicare levy. Very, very bad news. There was some long and involved tax consultations to re-engineer their situation to avoid what could have been a near 50% marginal rate paid on that exit event. Going to the next row here, QBI eligibility, directly eligible if conducting qualified US business activity. We've seen that, except for professional financial services and hospitality. And often problematic under US tax rules, may not qualify clearly for 199A benefits. So again, seeking appropriate cross-border tax counsel, can't emphasize that enough. Cross-border complexity, lower complexity, clearer IRS guidance on QBI eligibility. It's the US, it just makes so much sense to domesticate your entities and tax situation to work internationally, but from the US side, given the attractiveness and the growth potential of being based in the US. Again, higher complexity, potential double taxation and treaty interpretation issues. The potential double taxation can come not only from this, but can come from state residency, because remember, the tax treaties between Australia and the US are the sovereign federal governments. They're not the states. And often I've heard of war stories of the California Franchise Board not honoring the tax treaty and saying, well, we don't care if you're domiciled in California for our purposes, then you can pay Australian tax, but you also need to pay us as well. And we're not going to give you a tax credit for Australian tax already paid. So that can bring you up closer to a 60% marginal rate, having already paid the 47% in Australia, 45 plus 2% Medicare levy, and then 13.3 in California. Could be a very, very unpleasant outcome. So structuring inside here, direct ownership through a US LLC or partnership typically provides clear access to 199A deductions, and Australian family trusts are often less advantageous due to complexity under US tax code and uncertainty around QBI eligibility. Okay, we looked at the thresholds here. Cross-border ownership structures can complicate calculation of taxable income thresholds. That was just mentioned in that chart we're looking at a moment ago. So planning strategies for Australian owners. You need to carefully segregate US connected income from Australian sourced income to optimize threshold management. Again, this is a function more for your accountant to make sure that they're doing these things. Consider residency planning and entity structuring to manage taxable income levels strategically. I've got a great story on this front. It's not directly relevant to QBI, but it's a great one nevertheless. And that is, it's actually the same client, Silicon Valley business, very successful, valuation around $100 million US, and no one in the fancy suite of advisors, given that they were all domestically focused, knew the ticking time bomb that existed for my client. And that was, the client was on a green card, and all the advisors, all the tax attorneys and CPAs are focused on the exit event and how do we optimize it, and it's what's going to happen with this Australian family trust and blah, blah, blah. And I said, hold on a minute, guys. if we're thinking long term, the clients, as of next year, this was a couple of years ago, but as of next year, they're going to be a long-term US resident subjected to 877A, which is the US, the HART Act, and an exit tax. We could be looking at a monstrous exit tax if this client decides to move back to Australia. And lo and behold, during COVID, that's exactly what that family planned to do. So the advisors had known about this. It's not on their card. They're, as I said, domestically focused, not international. It's a whole different set of rules that come into effect. And this warning I had went up the flagpole. They validated what I said was true. And lo and behold, we saw that client very quickly extricate himself from the US to avoid that long-term US status. And he's now based in Australia and returns to the US on a temporary visa to avoid that horrible exit tax the US has. Okay, regularly review cross-border structures of professional advisors to ensure ongoing compliance and optimization under evolving IRS guidance. I am often asked, when's the right time to engage in planning? And the answer is as soon as possible. I am a sincere believer that the returns on planning are exponential. And it's not only investment returns, it's the broader structuring of one's whole estate. Speaking of estate tax mitigation strategies. Let's see what we have here. Now, the US has an estate tax. In 2025, it's actually a little higher. It's up to $13.95 million with portability between married spouses. So if you happen to be married and you've got an estate, then really you don't need to worry a great deal about this until your net worth exceeds $28 million. So really doesn't affect the vast majority of people, but nevertheless, this is a thing. And occasionally at Chamber of Commerce events, I'm thinking US, Australia Chamber of Commerce events, someone will try and sound clever and they'll say, oh yeah, but there's only a $60,000 limit for non-residents. Well, technically that's true, but it's the same thing that I say when people are talking about the totalization agreement. That's the rule, but if you've got a treaty, there's an exception. And lo and behold, Australia still has an exception there. So we've got a tax treaty, a totalization agreement, and an estate tax treaty at the US. One of the few countries that has all three. So we've got the trifecta. And the way it works for Australian expats is like this. The definition we need to be worried about is domicile. Where do you see yourself long term? Where are you living from here on out? And if the answer to that is Australia, then and importantly, you are not a US tax resident, i.e. not a citizen or a green card holder. The only concern that you have at that point then are those assets determined to be situs, that's Latin for sited, located in the US, in which case this formula here applies, as you can see. So you've got your US estate tax exemption, 13.95 million in 2025, times the value of your US situated assets. Let's say you've got $3 million of US assets. That's typically US situs assets is not always so clear cut. That's definitely going to include things like businesses that have an effectively connected income relationship to the US, real property like real estate. There's no way, actually, it's not true. I was about to say there's no way you could make real property be not US situs because it's clearly in the US, right? Wrong. Actually, if you put it into the right type of entity, you own your real estate in the right type of entity, and that entity is not deemed to be US situs, then actually you can change the situs of real property, which is really mind-bending and probably one of those things that if more people understood it, they would say it's really not fair, and that's the value that wealthy, high-priced advisors get. But then again, that is our job, is to get the best outcome for our clients. And so, we may not agree in the equity of the rule, but it is the rule, and we do the best that we can for our clients. So situs of assets is what's important there. So importantly, if you're a US tax resident, you're subject to that 13.95 million, even if you're domiciled in Australia, because once a US tax resident, always a US tax resident, unless you relinquish your your citizenship or green card. It will follow you wherever, from Antarctica to Zimbabwe, or anywhere in between. So that's what we need to worry about here. And if you are not a US tax resident, so just an Australian tax resident, then it's only your US assets that would fall into this formula here. So what are some more advanced strategies we might employ to help mitigate estate tax? An estate tax, it's essentially a 40% tax that applies to assets in excess of that $13.95 million limit. Well, there is an irrevocable life insurance trust. If you're going to have a big bill to pay, then maybe one way to deal with that would be to fund a trust, an irrevocable life insurance trust that's going to produce a big death benefit. So there's liquid cash available at the decedent's passing in order to pay for the substantial taxes that are due. Why would you do that? Because you might have an illiquid asset. You might have some sort of real estate holding or a business that you don't want to have to sell in order to pay the estate taxes. So it certainly has that advantage there. A grantor retained annuity trust. This is one of those very cutting edge strategies that's often on the chopping block when tax reform comes up. It allows a transfer of appreciating US assets to heirs at reduced gift tax costs. So kind of complicated how it works. Going into that in greater detail next month in the webinar that we're doing. And I'll include flowcharts as to how that works. But essentially, you're gifting it to your heirs. They pay you back a significantly lower amount, and then it's on them to own the asset. It's out of the estate. You've gifted it away. You've used your lifetime gifting exemption to do that, but you haven't paid 40% on that because the additional growth that occurs on that asset isn't happening while it's owned by you. Charitable remainder trusts. I happen to love charitable remainder trusts. I think they are fantastic and they are underutilized. What I would say, though, is that you need a couple. Well, firstly, you've got to be charitably inclined. If you don't care about supporting charities, then forget about this. But if you are charitably inclined, you're looking at a gift, I would say, of at least $1 million, ideally $2 million, to really overcome. There's a bit of admin cost and hassle involved with it. But the general structure works like this. Donor, that's you. You make a big gift to a charity that you support, but you say to the charity, listen, guys, I love what you're doing. Here's all this money that I want to give you, but you can't enjoy that gift that I've given you until I've passed, until I'm dead. So in the meantime, until I'm dead, I want you to pay me an income stream from that asset of around 5%. So 5% of the asset of $1 million, it's 50,000. Of 2 million, that's $100,000 a year. Pretty nice contribution to one's living expenses right there. And I'm going to receive a charitable tax deduction for what's deemed to be the remaining value of that trust in the future. So let's say I give $2 million today. We're going to discount that trust because I'm 43 years of age. I sell my business for a couple $1 million. I've got a big fat tax bill to worry about. I believe in supporting the environmental charities and so forth. The Nature Fund is one that I like. So what I'm going to do is give them $2 million. Given that I'm only 43, they'll say, we expect, IRS life expectancy tables tell us you're probably going to live for another 45 years or so. So if they pay you 5% for 45 years, the ending value of your $2 million gift is probably more like $800,000. We're going to give you a charitable deduction this year of $800,000. Perfect. Well, that's just what I want because I'm selling my business. I'm going to have a big fat capital gain. As a result of it, I'm going to owe $1 million. And so I can use my charitable gift and the remaining value of this charitable trust to offset my tax bill. So I only owe $200,000 because I've offset it by $800,000. And I get essentially this annuity of $100,000 for the rest of my life, or if the asset depletes, then it goes away as well. So that's what a charitable remainder trust is in brief. So pitfalls of Australian testamentary trusts under the US tax code. So an Australian testamentary trust is a type of will, basically, where a trust is created at your death and your assets go into this trust. It's a testamentary trust. It appears in your will and at your death, it's written in your will and appears at your death when your assets go into that. So they're popular for Australian asset protection tax efficiency, but again, problematic under US rules. This is why there's only 2 US Australian estate planners that I believe really know what they're doing and have experience in this field, and we refer our clients to them. These testamentary trusts can often be classified as foreign grantor trusts or foreign non-grantor trusts. Bad news, you don't want that. Punitive tax rates apply, as well as additional forms that need to be filed. Unintended US tax consequences, potential double taxation, loss of favorable Australian tax outcomes due to mismatch in treatment between jurisdictions. Distributions to US resident beneficiaries may attract punitive accumulation. Throwback taxes, I don't know all about throwback tax. That's kind of where I've historically drawn the line. That's my tax attorney friends that know about throwback taxes, but they tell me it's very nasty. Recommended alternative strategies. Consider a US compliant trust or direct inheritance strategies to simplify cross-border estate administration. That's often what we're seeing for mass affluent clients, especially those that are only going to be in the US for a little while longer. No one knows when they're going to meet their maker, of course, but if you're intending on moving back from the US to Australia in the not too distant future, a lot of the estate planning can actually can be done directly. And what I mean directly is in the titling of accounts. Many investment accounts allow for what's called the transfer on death nomination. So you can actually just put the name and social security number of the beneficiary right there in the account. And when you pass, you need only present a death certificate back to Schwab or Fidelity or whoever that custodian is. You say, hey, that's my account now. It says it right there in the account forms. Thank you very much. Same with 401ks, same with IRAs. They can all be handled or many of them can be handled in this way. Real estate, not so much. That's where you would need a revocable living trust. But many folks that are just about to leave the US are renting anyway because they want to make use of their capital gains exemptions before they leave. So recommended alternative strategies, consider US compliant, as I just mentioned, proactive planning essentials, engage specialist advice. This is one of those areas where I know broadly about these strategies. I know what can cause problems, but I'm not a lawyer. I'm not writing these documents. That ends up being a separate engagement, but being forewarned is forearmed. Exit tax and expatriation planning. Not going to go into a ton of detail on this, in large part because I have done that in as recently as January. January's webinar was an exit tax update. So if that's of interest to you, please go to the YouTube channel and you'll find a whole hour with flowcharts and details and updated numbers where we talk about this. So Internal Revenue Code Section 877A is where the Hart Act is mentioned. It deals with what's called a covered expatriate. And they're deemed to, what happens is a deemed disposition, a deemed sale of their worldwide assets at the fair market value the date before their expatriation. What does that mean? That means all your assets everywhere need to be considered. Do you meet these 3 tests? Here are the 3 tests right there. You've got your net worth test, which is not indexed for inflation, which is horribly unfair, but that's like the Australian tax code, which is also not indexed for inflation. There was an article earlier this week in the Financial Review where they said, I think by 2032, the average taxpayer will be in the 45% bracket in Australia because the rates are not indexed. And so they just eventually capture through bracket creep is what it's called. Well, it's the same thing here. That 2 million is not adjusted. The exemption, that 866 that you see up here, that is adjusted. So they're catching more and more people with this net worth test. The next test is the net income tax test. 5-year average annual US income tax liability exceeds that. Now, that's not your US income, full stop, period. It's not your US income. Did you have income greater than 201,000? It's your income tax. Did you have federal tax average higher than 201,000 over the last 5 years? You've got to be making pretty good money to have an average of that amount. Coincidentally, a new client of mine in the tech sector is making very good money, 7-figure income. Well, he's moving back to Australia with his family in a couple of years' time. 2 years' time is the plan. And he's going to be subject to this. So he's going to have to wait probably 3 years until his average federal tax liability falls below that 201 inflation indexed threshold. Last one is the certification test. We never have this come up because we don't work with clients who aren't interested in being compliant with their taxes. So that's an easy box for us to tick. Green card holders, key considerations here. Green card holders become long-term residents after, really after 7 years. So any part of 8 years or thereafter, 1 minute, 1 second in the country will count if it's into that 8th year. And relinquishing that green card before reaching a long-term resident status can avoid that covered expat status entirely, and staying on a temporary visa never starts the clock. So if you're able to come on an E3 or L1 or O1 or some other kind of visa, then that might be preferable despite the hassle of having to renew that every couple of years. Some strategies to avoid the expatriate status would be transferring assets to a non-expatriating spouse to lower one's net worth, establishing a pre-expatriation trust, gifting to that. That comes back to the previous topic to do with estate tax strategies. It's essentially a derivative of that. So you gift to a trust. A trust, you are one of the named beneficiaries, and so are a number of other classes of beneficiaries, can't just be you. And so you make that gift, say, hey, that's out of my estate now. I'm not worth more than $2 million. You may have a trust that will eventually come back to benefit you, but it's not yours for the time being. It's kind of like if you mailed yourself, as ridiculous as this sounds, this is effectively what it is. You mailed yourself a gift of valuables through FedEx. You just send it to FedEx, and then you're sending it back to yourself. Well, in that time that it's in the mail, if we looked at what assets you have available, well, we can't include that's actually not available. So that's the logic there. Asset transfers prioritize gifting non-US status assets to minimize US tax exposure. I think it's broader than that. Prioritize, I'd say, gifting assets because it considers your global net worth there, not just non-US status assets. Be mindful of average annual US income tax liability. This is where making contributions to retirement plans or deferred compensation plans could be very beneficial. I'm very excited for a client who I've recommended he speak with one of these cross-border estate tax estate and tax attorneys to do with the deferred comp plan. He's been making very good income for the last 10 years or so. He has access to what's called a 457 deferred compensation plan. He's now got $1.5 approaching $2 million in that, and it looks like that it might be possible to take a tax treaty angle on the distribution of that, which basically means a 100% step up in basis on, or nearly. It may not be 100%, but very close to that, given the way that the tax treaty is written. So certification, you want to complete your 8854 on your way out the door. That's one we definitely recommend using an appropriately experienced CPA firm to do, and that will complete your exit from the tax point of view. Community property states, California, Nevada, and Texas, keep in mind they have co-ownership of assets split between spouses. That can complicate expatriate planning due to the joint asset valuation. And I've always struggled conceptually to understand community property versus joint property. And that is, joint isn't necessarily 50-50. There are ways of making a case to say, hey, this asset, I brought it to the marriage. Actually, I had this with another client who's looking at expatriating possibly as soon as this year. She got inheritance from her dad. She contributed more than 50% of the account value, which is very convenient because the husband is the breadwinner in this situation, and we want to decrease his value because he's above 2 million otherwise, and we can increase hers, and she'll be below 2 million. It works out well. Neither is a covered expat. If that can go through, again, that's something. Leave that to the tax attorney to take up. Common law title consideration, separate property ownership allows flexibility in asset and gifting strategies. So very common step that we take when doing this exit tax planning is we want to really get clear on who owns what. Joint assets to split what is already a joint asset can be viewed as a gift, and there are gift limits for permanent resident spouses. Even a permanent resident spouse with a US citizen spouse, there's I believe it's $191,000 this year is that annual gift limit, meaning the US citizen spouse cannot gift more than that to the green card holder, because the US is worried that they might leave and they may not get their take. US citizen spouses have an unlimited marital gifting rule that applies to them. So gifting and splitting of assets is desirable, but needs to be done over a long term in order to minimize these kinds of complications. Actionable tips here: draft clear agreements specifying ownership intentions for real and other assets. Again, planning is required, people, to make sure that these things are done correctly from the outset. Not necessarily so problematic in the US, especially between US citizen spouses, there's really no problem. But in Australia, it is massive. It is massive in Australia, because if you transfer a title, say, of real estate to a trust, that's what's called a dutiable transaction. Stamp duty comes up, and we're looking at an average rates across the country about 6%. So if you want to move a house out of your name into a trust, into some sort of family trust or whatever, you could be looking at 6% of the assessed value to do that, which could be, with the average value of real estate in Australia these days, getting into the 7 figures, is going to be real money. And you can see right there that the planning on the front end would have avoided that entirely. Post-exit wealth preservation. So this is another topic where we'll be spending next month's presentation going into this in detail. But we need to, the first point here is understanding state tax variability. And so any recently arrived Australian will soon be learning about state tax. It's barely a thing in Australia. Of course, it does exist with a few narrow things like stamp duty. But in the US, it's huge. Of course, we have to file a state tax return in states with state taxes. This happens, I think, post-COVID really put the wind at the back of people who were thinking of moving to Texas or Florida, Nevada to a lesser extent, but they've had enough of California governance and taxes, and so they're moving there. If someone was moving to the US with the thought of really doing it as best as they could from a financial point of view, that might be a good recommendation. Of course, another thing to consider would be QSBS eligibility for companies incorporated in those states. California and New York. Remember, in Manhattan, Australians, like moths to a light bulb, they are drawn to move to New York. Unfortunately, New York City, there's a special city tax. As far as I know, it's the only city tax in the country. But if you live in New York, you got to worry about city, state, and federal taxes. So that can have an untoward impact there as well. It seems to me the sophisticated types on the East Coast tend to catch the train into town from Connecticut rather than actually live in New York. And that way have the much lower state taxes of Connecticut than New York. If one's thinking of an exit, you might plan on moving beforehand to avoid the lecherous tentacles of California and New York. Very difficult to do that. There's lots of steps to go through to be well and truly clear of those tentacles. And states like Florida and Texas offer tax relief, but require genuine. You cannot say, I've got a post office box in Florida, therefore I'm living. It's real. It's serious. I'm going to see your address. They're counting the number of days that you're there. It's your local GP based out of Florida as well. So you really will have to actually move. Okay, so what are some other cross-border philanthropic vehicles? I spoke briefly earlier about a charitable remainder trust. Well, it turns out there's a whole range of tools in the toolkit for philanthropic giving. One of our most common is a donor-advised fund. We like it because it's very simple. It's very simple to communicate. It's very flexible too. The idea here is that you give low basis assets. Doesn't have to be stock in the Magnificent Seven. It could be stock in a closely held business, possibly. So what you do is you gift that to the charity then sells it immediately, and then you have an account, essentially an investment account equal to the value of the gift that you made. You get a tax deduction for the fair market value of the gift that you made. Why is this a clever thing to do? It is super self-evident why this makes sense, because your alternative is selling your highly appreciated asset, paying capital gains tax on it, and then gifting the cash to the charity. Whereas if you give the business interest or share in the business to the charity, they don't pay tax on that. You get the full tax deduction of the gift that you made to them. Private foundations, that's a little bit higher net worth before we begin to worry about that. You're talking about significant contributions, probably in the order of $10 million and up. It's ideal for families seeking greater control and visibility in their charitable efforts. Combine this with this die with zero approach that we believe in. The idea being you making your gifts during your life, not necessarily waiting for everything until the end. Maybe leave a little bit at the end, but certainly make sure that you've got sufficient assets to get through your life, countering for higher inflation, lower investor returns, higher expenses. Figure out what you will absolutely need, and then be mindful of what you're able to give throughout your life, and see the effect, live to see the effect of what you're doing. So Australian donors have got to navigate differences in tax treatment between Australia and the US, and structure gifts through compliant vehicles, ensuring alignment with both jurisdictions' tax laws. I actually did a webinar on this some time ago, so you can find that on my YouTube page. Now, other practical strategies for post-exit wealth preservation would include things like tax loss harvesting. Now might be a time to do it. We're having a mini correction down from the peak of about 10%. I think even more effective than that, or a better implementation, is what's called direct indexing. That's essentially where you own the entire index in individual stocks, employing an algorithmic trading program to automatically on a daily basis capture those losses to make for a very, very tax effective investment strategy. That's something we just did actually for a client who sold his business to a private equity firm. He's walked into $13 million, and that's the best practice for tax efficient investment for an investor in a high tax bracket. Residency coordination, align personal residency status with business and investment structures to optimize cross-border tax outcomes. Obviously, we can only do the best planning with the information we have available today, but the returns on planning are exponential, as you've heard me say. Global asset allocation, you want to be mindful of your overall geographic concentration. BlackRock actually just published an article last week saying that they're decreasing their exposure to Australia. They think they think it's a fact. It only represents 2% of the total globally listed companies, and now that the valuations are unattractive and there's better opportunities elsewhere. Excuse me. Engage cross-border advisors. Obviously, that's a role we're auditioning for, but I hope you can see with the presentation today, with the variety of strategies presented, that there really is an awful lot of complexity to consider as a cross-border business owner who might be looking to make advantage and take advantage of those tax and estate and exit and post-exit strategies that are available. If you're interested in learning more, please come to my website, click on Get Started. It'll walk you through what our prospecting process looks like. We start with a 15-minute phone call, then a 2-hour fit meeting, and then if we see alignment following that fit meeting, then we'll proceed to work together. Next month, as I mentioned, we're talking about navigating the next chapter, sort of the post-exit consideration. So estate tax mitigation and wealth preservation strategies. We'll go into GRATs and DAFs and every other acronym that I've mentioned here today. Open to your questions at this time. I think I must have either been absolutely spellbinding and riveting, or absolutely boring and have put everyone to sleep. Normally, we have a good amount of interaction here, so now would be a suitable time to ask any questions you may have. I'm going to stop sharing at this time, so that'll take that away so I can see the Q&A. Doesn't look like there's any Q&As or chats, but maybe folks are just busy typing in their questions or not. Either way, want to say thank you for your interest in this topic. If you're open to it, I'd greatly appreciate just making a mention of me to anyone you know who might be looking at these sorts of questions and considerations of cross-border wealth management. So thank you very much, and I hope you can join us next month. Remember, April 15th, where we go deeper. Gaurav has just asked, a testamentary trust still a problem if they are short-lived? Well, short-lived is a question. Just holding property till someday, till sold. Yeah, I would imagine that's exactly when they're going to be problematic, is at that point. I would say they're not problematic until that point when the trust comes up, because at that point there is no testamentary trust per se. It's a will with a provision to create a trust at someone's passing. So it's precisely then that's the problem. But Gaurav, you'll recall the second slide today. Gaurav, what was it? You were running pretty early. This is not personal financial tax or legal advice. You would do well to talk to an appropriate estate tax planner or tax professional on just such a question. Something in the Q&A has appeared. Nancy, what are the issues surrounding end-of-life documents from California? Do you want to be more specific there? So you're talking about a Californian will? Is that what you're, and trust? Is that the concern? What are the issues surrounding end-of-life documents? So will, trust, what else are we talking about? Living will, anything else there? I'll just give you a second to maybe write a clarification. HIPAA, well, HIPAA's really to do with information sharing or non-sharing. California Advanced Healthcare Directive. Well, so those things are going to be compliant in, I mean, presuming it was written by a Californian attorney, going to be compliant in California. In Australia, however, I really am, I'm in no position to give you any recommendation as to the veracity of those documents and enforceability in Australia. My instinct would be to, and yours too probably, would be you need to get Australian documents so that they're honoured in Australia if you have indeed performed that move here. That looks like it. Hey, folks, thank you so much and have a wonderful rest of your day. I appreciate it. And thank you. Bye.